today, and I'd like to now invite Julie Hudson to come up. Julie's our Managing Director and Head of Global Sustainability Research at UBS. Julie.
So good afternoon, excuse me, ladies and gentlemen. It's a pleasure to be here on behalf of UBS, thinking about why integrated reporting is important to investors. And there's really only one answer to this question from our perspective, and it was expressed in the title of our integrated reporting report last year. We asked, what is integrated reporting? And we answered it's how good disclosure connects to value. In general, when investors look at disclosures or indeed at the analysis undertaken by analysts based on company disclosures, they do so in order to understand companies better. The most focused purpose of that analysis is to decide whether any given company belongs in a portfolio or not. A broader interpretation would say good disclosure by companies, in general, can help investors understand sectors and markets, potentially also providing insights to asset allocation decisions. But of course, it's even broader than that. It's increasingly the case that the capital market model in which all roads lead to the shareholder is being challenged. When the post-credit crunch dust settles, stakeholder models may turn out to be much more in evidence. And for this, integrated reporting is absolutely required. Now, as you can see from my title slide, I work in the areas of sustainability and ESG integration. So there is something I really want to stress here. The transition to integrated reporting is not just about ESG and sustainability. It matters to all investors, whatever they specialize in. But of course, the integrated reporting and ESG integration agendas connect. Enlightened mainstream investment practitioners are ESG integrators, and therefore they need integrated reports. In 2012, when we began to look at integrated reporting in detail, we decided we needed to define it. And we consulted and debated internally, and we consulted with many stakeholders. There are probably several of those people in the room, but I can't actually see anybody with the lights. But thank you very much, the people who helped us. And the definition we came up with was, it is a new approach to corporate reporting designed to allow investors to make insightful connections between key pieces of information, thereby smoothing the investment process. We would expect one of the benefits of good integrated reporting being widely adopted to be improved market efficiency, because disclosure, good disclosure, connects to value. And it does so by reducing the number of potential surprises, because of course, disclosure is a two-edged sword. Information can enhance value or can destroy value depending on what it is. Unnecessary uncertainty is perhaps the most value-destructive force that there is. And I think integrated reporting is an answer to that problem. Having said that we address integrated reporting as bringing value added to the table for all investors, I want to look briefly at an example of the overlapping agendas I just mentioned, the ESG integration with integrated reporting. At UBS, we publish a big document called the ESG Analyzer. And this publication is based on an internal survey in which about 100 UBS analysts tell us what they see as the material ESG issues for companies in about 29 sectors. In 2012, in my team, the sustainability team, we executed a deep read of their responses because we wanted to identify what UBS's highly skilled mainstream teams see as the issues that are material and therefore should, by implication, find themselves in a properly integrated report. So I'm going to show you just a couple of charts. This first chart shows you the most frequently mentioned environmental issues. So I'm not sure whether you can see this, so I'll just briefly pick up one or two of them. Access to resources and resource-related ideas, such as resource efficiency and recycling, and environmental regulation, appeared as important in over 2/3 of the sectors, so about 20-something sectors out of 29. Greenhouse gases surprised us by popping up in about half the sectors we covered, even though those markets seem to have done less well perhaps than expected. Sometimes greenhouse gases are a control issue for manufacturers or energy generation. Sometimes they're a potential cost issue. Sometimes they're an opportunity. The point I really want to emphasize is that all of these are material issues for any investor, and a solid integrated report should communicate why they matter, where they connect to strategy and execution, and company financials over what sort of time period. Moving on to social themes, we were unsurprised to find themes like regulatory change, the aftermath of the credit crunch, human capital management, which we defined as including R&D and intellectual property. Here too, all of these issues are material in the sectors that they appear in. An understanding of such issues and how they connect to the business model is exactly what a good integrated report should deliver. So now going back to my overlapping agenda, I want to point out something in this chart which was a real surprise to us. About halfway down, and I'm not sure, I probably don't think the pointer works, but about halfway down, you'll basically see that in about just under half of the sectors covered, analysts commented on the need to balance social and commercial obligations alongside social value created as an asset. So the message emerging from the UBS analyst survey, notice mainstream analyst responses, is that the stakeholder model is arriving. So I want to stress that balancing social and commercial obligations is not just about social entrepreneurship undertaken somewhere out there in another sector called social entrepreneurship. And I'm going to demonstrate this just by briefly describing the way the ESG Analyzer survey works. So the first three questions that we direct at the analysts are, what drives your industry? And this is, in the mainstream, anything that drives the industry, of course, including key dependencies mentioned by the previous speaker. So what drives your industry? What are the key strategic differentiators for companies in your industry? And what are the financial metrics you commonly look at? Now we've got the industry on a postcard and we understand in a somewhat rudimentary way how it works. Now we want to know what are the environmental or social issues that would change the model, the strategy, or the metrics? And what are the governance issues that would change model, strategy, or metrics? And then we step back again and we say, okay, business as usual, what are the main opportunities and threats for companies in your sector? And now we know those. Are there any environmental, social, or governance catalysts that could change that landscape? So you can see that our survey really addresses two pivotal questions. Which ESG issues or trends might change the business model, strategy, or key metrics? And could ESG issues or trends change the outlook in terms of opportunity or risk? But of course, these questions are absolutely contextualized at the core of the sector. Brainstorming with Paul Druckmann last year, as we worked on our integrated reporting report, we came up with a powerful diagram which sprang from a more complicated one on Paul's office whiteboard. And you saw the core of that diagram on my second slide. There's a little Venn diagram with the integrated report in the middle. So now for the stakeholder version. This is the picture of the fully integrated reporting model, reflecting the fully integrated business model in which good governance pulls together the right balance between stakeholders, short to medium-term investors, long-term investors, sustainability specialists, regulators, NGOs, customers, suppliers, and so on. So, returning to the question I began with, why is the transition to integrated reporting so important to investors? Integrated reporting anticipates the sustainable world we need to move to, one in which externalizing costs unreported and unasked isn't good enough. There is really only one answer to this question from the perspective of all concerned. Good disclosure connects to financial, economic, social, and environmental value. In short, it connects to enlightened stakeholder value. Thank you.